Hi there, accountants. I hope all is well, and I pray that as you're viewing this video, that you're in the best of health and spirit. This video will cover Chapter 8, Depreciation and Sale of Business Property from Income Tax Fundamentals 2024. By the end of this chapter, you should be able to explain the concept of capitalization and depreciation, calculate depreciation expense using the MACRS table, identify when a Section 179 election to expense the cost of property may be used, apply the limitations placed on depreciation of listed property, apply the limitations on depreciation of luxury automobiles, calculate the amortization of goodwill and certain other intangibles, classify gains and losses from Section 1231 assets, apply the depreciation recapture rules, apply the general treatment of casualty gains and losses for business purposes, compute the gain on installment sales, calculate recognized and deferred gains on like-kind exchanges, and lastly, calculate recognized and deferred gains on involuntary conversions. So, we're going to learn about capitalization. And capitalization is the process of recording an expenditure for an item that provides benefits over a long period of time. So capitalization is essentially depreciation. So let's say you pay $15,000. We'll just use it from the perspective of a homeowner. You pay $15,000 for a brand new roof. Essentially, you do not claim the full $15,000 in 1 year. Instead, you will depreciate it over a set number of time. And depending essentially on what the expenditure is, that ultimately would depend or determine rather the number of years. So expenditures for the following require capitalization. So if there's betterment, fixing a material condition or defect that existed prior to the acquisition of the property, adaptation to a new or better use, making changes that allow the property to be used in a new or a different manner, or restoration, replacing a major component, a substantial structural part, or a combination of parts. As it relates to capitalization, we have what's called a de minimis safe harbor election. And what this simply means is that a taxpayer is permitted to deduct an item of tangible property to the extent that the item is deducted on the taxpayer's books and records up to a specific amount. So keep in mind, when we see this word tangible, what that means is an item that you can perceive with your five senses. You can touch the item, you can physically see the item. That is a tangible item versus an item like goodwill, which we're going to learn about. It has value, however, we can't physically see it. So as it relates to the dollar limits, the dollar limit is $5,000 per invoice or invoice item if the taxpayer has applicable financial statements, which is often referred to as AFS. And in the event that the individual or the taxpayer does not have AFS, then the limit is $2,500. And AFS, those are basically financial statements that are filed with the Securities and Exchange Commission, and it's audited financial statements with an accompanying CPA report, including those that are prepared for a creditor, if it's being reported to shareholders, or provided to the state or government agency. As it relates to the safe harbor for routine maintenance. So when there's non-building property, there's an additional safe harbor that's associated with restoration costs. And under the safe harbor, costs that are incurred to restore property, it can be deducted if the restoration is an activity that would be reasonably estimated or expected rather to be performed at least twice during the useful life of a property. So again, think of it like a home, the roof, there's wear and tear, especially, living in a place like New York, where there's, a range of weather patterns. 1 minute there's spring, the sun is beating on the roof, then there's the winter, there's snow on the roof, so there's wear and tear. So it can be depreciated if it's active, if the activity is reasonably expected. All right, we know there's wear and tear. Then we have the small business safe harbor. Lastly, there's a safe harbor for small businesses that have annual gross receipts of $10 million or less, and ownership or lease of buildings with an adjusted basis of $1 million or less. In this safe harbor, it essentially permits the deduction of costs for work that are performed on owned or leased buildings if the total amount paid during the year does not exceed the lesser of 2% of the unadjusted basis of the building property, or $10,000. As it relates to depreciation is the accounting process of allocating and deducting the cost of an asset over a period of years. So just keep in mind, the term depreciation, it does not necessarily mean the deterioration of loss of value of the asset. And one thing to keep in mind is that land cannot be depreciated for tax purposes. So again, as it relates to depreciation, a lot of long-lived assets, they're used in business production over a number of years. We essentially have equipment, there's buildings, there's machinery. So in those cases, whenever there's accrual-based income, it's not properly measured if the entire cost of the asset is going to be deducted in a year that the asset is purchased. So that's why depreciation is utilized. Again, it's the accounting process of allocating the cost. So for example, let's say a taxpayer, they purchase equipment for $5,000 and they anticipate that the equipment is going to be used, is going to help to generate revenue in the business for 5 years. Instead of claiming the full $5,000 in the first year, the year of purchase, they will allocate it over the estimated useful life. And each year for the next 5 years, they would claim depreciation of $1,000. Next, we move on to MACRS or MACRS, depending on, how you want to pronounce it. This stands for Modified Accelerated Cost Recovery System, and we'll also learn about what's called bonus depreciation. So for tax years after 1980, there were some modifications in the tax law. They helped to encourage capital investment. Obviously, because, money being spent in a business, it's not just from a book purpose, accounting purposes, but it also has tax implications. So as a part of this change in the tax law, the accelerated cost recovery system, ACRS, was enacted, and then it was modified in 1986, and that became a part of the current tax depreciation system, which we now refer to as MACRS, the Modified Accelerated Cost Recovery System. So this current MACRS, it allows taxpayers who invest in capital assets to write off an asset's costs over a period that's designated in a tax law, and they can use an accelerated method for depreciation of assets other than real estate. Obviously, there's some nuances, there's some caveats to it. The minimum number of years over which the cost of an asset can be deducted, that's often referred to as the recovery period. It ultimately depends on a few things. It depends on the type of property, in addition to the year that the property was purchased. And the recovery period, they're based on the asset depreciation ranges that's published by the IRS. So there is a schedule of the recovery periods for assets that are acquired after 1986. And we have an example of that table here. And here we see for the recovery period of 3 years, 5 years, 7, 10, 15, 20, 27 and a half, and 39 years. So we see that for assets that are between 3 years and 10 years, they have a 200% declining balance. That's the method they use. 15-year and 20-year property, they have the 150% declining balance method. And for a recovery period of 27 and a half and 39 years, it's the straight line method. And, here it basically lets you know the ADR midpoint life of 4 years or less. This excludes cars and light trucks. ADR midpoint life of 4 years, but less than 10 cars and light trucks, office machinery, etc. So in the event that a client, purchases equipment, then it is helpful for you to be able to, discuss with them, especially from a tax planning perspective, because ultimately they'll want to know, hey, if I purchase this asset, what's the bottom line effect as it relates to taxes? So under MACRS, taxpayers, they calculate an asset's depreciation using a table that contains a percentage rate for each year of the property's recovery period, and then they apply this yearly rate to the asset's cost. The cost of the property to which the rate is applied, it's not reduced for prior year depreciation. So definitely important to keep in mind. Under MACRS, we have what's called a half-year convention. And with this half-year convention, that is essentially where the under MACRS. So let's say a taxpayer, they have depreciation or they purchase an asset rather, and they purchase it towards the latter part of the year. So let's say they purchase it in like November, or let's say October, right? So we have this half year convention. So this applies for 6 months of depreciation during the year that the asset is first acquired, and then there's 6 months of depreciation during the year that the asset is fully depreciated, sold, and disposed of, because obviously Uncle Sam don't play that. And what a lot of companies will do is they say, hey, you know what, let's say they purchase equipment for $10,000. It is a 3-year equipment. They would, get the full $3,333 worth of depreciation, even though they really only purchased this asset in, let's say, November or October. So we have what's called, again, the half-year convention. And this is an example of what you see here: accelerated depreciation for personal property, assuming the half-year convention. So this is recovery year 1, and it goes all the way through 21. For property other than real estate, taxpayers, they may elect to use the straight line depreciation instead of ADRS under MACRS. Taxpayers, they must use the straight line MACRS table for assets for which the straight line election has been made. And under MACRS, the same depreciation method, accelerated or straight line, may be used for all property in a given class placed in service during that year. So here we have this example. It states, what is the depreciation expense deduction for 2023 and 2024? On March 15, 2023, Natura Tech Co. purchased bamboo furniture for $180,000. What is the recovery period? So based on this, according to table 8.1 that we saw, shows that the recovery period for business furniture is 7 years. Using the percentages in table 8.2, the depreciation expense deduction for 2023 and 2024 will be calculated as follows. So for 2023, the rate is 14.29. So the depreciation would be $25,772. And in 2024, the rate is 2.449. Therefore, the depreciation would be $44,082. We have another example in the States. What is the depreciation expense deduction for 2023 and 2024? It states, on February 3rd, 2023, Luminex P. LLC bought a radio frequency identification RFID inventory control system for $12,000. What is the recovery period, and what is the depreciation expense? Table 1, again, that shows us the recovery period for an RFID inventory control system. The recovery period is 5 years. And using the percentages in table 8.2, the depreciation expense deduction is calculated as follows. In 2023, the deduction is 0.200 for 2,400. And in 2024, the deduction is 0.3200. So therefore, they would claim depreciation of $3,840. So generally, when you're using a tax software, the tax software, is going to calculate it, but obviously you would need to input, as you are adding the asset, you would need to input the recovery period essentially, and you would need to refer back to the guidelines. Some tax softwares, they might have something embedded whereby you can answer certain questions, and then the software will determine how it should be, what the recovery period should be. But again, you always want to be able to confirm what the recovery period is, because you don't want Uncle Sam getting involved. Next, we have the mid-quarter convention. So with the mid-quarter convention, this must be applied if more than 40% of the total cost of a taxpayer's property acquired during the year, other than real property, is placed in service during the last 3 months of the year. So similar to what I was mentioning earlier, the mid-quarter convention treats all property placed in service during any quarter of the tax year as being placed in service on the midpoint of the quarter. So if the mid-quarter convention is applied when the asset is acquired, it must also be applied upon the asset's disposition. So we have this example here, and it's asking us to calculate Chavez Smart Build's depreciation for 2023. And it says Chavez Smart Build Incorporated, a calendar year taxpayer, purchases property during 2023 for use in its business. Data pertaining to the property is as follows. It was placed in service March 15th. With a cost of $5,000 and the recovery period is 5 years. And then there was another item, property purchased October 12th with an original cost of $225, and the recovery period is 7 years. So in this case, since the $225,000 is greater than $50,000, that's essentially more than 40% of Chavez Smart Bill's purchases, and they were obviously made within the last 3 months of the year. So in such case, the mid-quarter convention is going to apply, and using the percentages in table 8.4, the depreciation is going to be follows. It's the $50,000 multiplied by 3.5 plus $225,000 multiplied by 0.0357, and then we add the two to get the net amount of depreciation for the year, which would be $25,532.50. Next, we move on to bonus depreciation, right? Because sometimes it's like, you know what? It's great that they have this accelerated system, but it would be even greater if we can take, more of a depreciation. So because the cost recovery of long-lived assets occurs over many years, one way to lower the after-tax cost of these capitalized expenditures is through accelerated depreciation. And sometimes the tax law is providing for that through what's called the bonus depreciation. And this provides an immediate deduction of all or some of the cost of otherwise slowly depreciated property. With the Tax Cuts and Jobs Act, please note that there was an increase to the bonus depreciation percentage to 100% of qualified property that was acquired and placed in service after September 27, 2017 and through December 31st, 2022. Keep in mind the 100% bonus depreciation does start to phase out in 2023, or did start to phase out rather in 2023. 2023 80%, 2024 60, 2025 40%, 2026 20, and 2027 0%, but things might change. So bonus depreciation, it's presumed to apply unless the taxpayer elects out of it. Between bonus depreciation and expanded immediate expensing under Section 179, small businesses, they're not likely to capitalize the cost of non-real property unless they either have a net operating loss, so it's like we already have a loss, really doesn't make sense to depreciate, or to take the bonus depreciation, or they anticipate using larger depreciation deductions during higher tax bracket years in the future. So they'll hold off on claiming the bonus depreciation until it makes more sense. So here we have this example. It says, assume no bonus depreciation was taken. What is the depreciation expense for 2023 and 2024? It says Nicole purchases a cherry desk and an executive chair for use in her engineering firm on July 16th, 2023 for $8,150. So table 1 shows that the recovery period for business furniture is generally 7 years. Using the percentages in table 8.2, the depreciation expense deduction for 2023 and 2024 is calculated as follows. In 2023, the total equipment is $8,150, and the percentage is 0.1429 for total depreciation of $1,165. And in 2024, the rate is 0.2449 for total depreciation of $1,996. Now, as it relates to real estate, For real estate acquired after 1986, MACRS requires that these property be depreciated using the straight line method. So the straight line MACRS realty tables for residential realty, for example, an apartment building, they provide for depreciation over 27 and a half year. Non-residential realty, for example, an office building, is depreciated over 39 years. And it would be 31 and a half years for realty that was acquired before May 13th, 1993. Next, we have what's called the mid-month convention. And with the mid-month convention, this is for the depreciation of real property under MACRS. A mid-month convention replaces the half-year convention. And again, this applies to real property. So real estate is treated as placed in service in the middle of the month that the property is placed in service. And likewise, a disposition during a month is treated as occurring on the midpoint of such month. So just keep that in mind. So for example, under the mid-month convention, let's say an asset was purchased and placed in service on July 2nd. It's being treated as placed in service on July 15th. And the mid-month convention, it's billed into the first year's rates in the corresponding IRS tables. Here we have an example. It's asking, what is her depreciation for 2023 and 2024? States Gina purchased a residential triplex on August 1st, 2023 for $290,000, including land cost of $50,000. So table 8.1 lets us know the recovery period for residential real estate is 27 and a half years. Land we know is not depreciable, so therefore only 240,000 can be used for depreciation purposes. So it's the 290,000 minus the cost of land. Using the percentages in table 8.5, the depreciation expense deduction for 2023-2024 is calculated as follows. In 2023, the rate is 0.01364 for a total of $3,274. And in 2024, 0.03636 for a total of $8,726. So again, generally the tax software is going to factor in this information. The tax softwares, they generally prepare the current year depreciation, and they also prepare worksheets for future depreciation as well to kind of help to, take away any guessing of what the amounts will be. But again, ultimately, you would need to confirm what type of, property is being placed in service. Is it real property, real estate? Is it equipment, things of that nature? And then you use the tables accordingly. As it relates to reporting depreciation expense is reported on Form 4562, and depreciation expense is not required to be reported by taxpayers who have no current year asset additions or they are not reporting depreciation on listed property. Next, we move on to the election to expense, Section 179. So there was a landmark Tax Reform Act of 1986, and the Internal Revenue Code Section 179 was essentially implemented to decrease the cost of investments in business property. And what this essentially did, this section of the Internal Revenue Code, it permits small businesses to expense the cost of certain property that would otherwise be capitalized and depreciated over time. So again, the key thing is, all right, the company paid $50,000 for equipment. Instead of having to depreciate it over 7 years, or 5 years, depending on, the type of equipment. In such case, now they can write off the $50,000 in the first year, in the year of purchase. So that's the difference between expensing it. That means that you get to claim the full amount of the cost in the year of purchase versus capitalizing it, where the cost is allocated over the recovery period. So under Section 179, taxpayers, they may elect to expense the acquisition cost of new and used personal property, which is property other than real estate or assets used in residential real estate activities, placed in service during the year and used in a trade or business. Section 179, it places 3 limitations on the expensing election. There's a maximum amount on the annual amount expensed. So in 2023, the maximum amount is $1,160,000, and there's a phase out of the annual amount limit. So the $1,160,000 maximum expense amount, it's reduced dollar by the amount of the Section 179 property acquired during the year in excess of $2,890,000. In addition, there's a taxable income limit. So the amount that may be expensed annually, it's limited to the taxpayer's taxable income before considering any amount expensed under Section 179 election from any trade or business. So definitely important to keep in mind, all right? Because you definitely don't want to be able to, create a net operating loss. If the taxpayer elects Section 179 for immediate expensing and uses the bonus depreciation, the cost basis of the property is reduced in the following order. First, it's reduced by the Section 179 deduction, then by the bonus depreciation, and then by the typical MACRS depreciation. So here we have this example. What is the total depreciation? On May 2nd, 2023, Nano Paint Incorporated purchased equipment for use in its business. It is the company's only purchase of business property in 2023. The equipment cost $1,540,000 and qualifies as a 7-year maker's property. Nano Paint's business income before any cost recovery is $1,075,000. Nano Paint elects to immediately expense the entire allowable amount, and it elects out of bonus depreciation. So we know that the maximum annual amount that can be expensed under Section 179 is $1,160,000 in 2023. And because Nano Paint elected to immediately expense the entire $1,160,000, which is essentially the $1,540,000 less the maximum, there's a remaining basis subject to MACRS, which is $380,000. So in such case, we see that this $380,000, which is the remaining basis, times the applicable percentage of 0.1429, that gives us a deduction for depreciation of $54,302. So therefore, Nano Paint's taxable income before the Section 179, it's reduced to $1,020,698. So therefore, Nano Paint, they can only immediately expense $1,020,698 due to the income limit. So essentially what happens, the excess of $139,302, that deduction will be carried forward to 2024. So they don't lose it. It's basically just carried forward. As it relates to listed property, so Congress, they felt that, some people, some taxpayers, they were using the favorable tax incentives of accelerated cost recovery system and the limited expensing election to claim depreciation deductions or on assets that were used for personal purposes. And we know Uncle Sam don't play that. So therefore, in order to help deter this perceived abuse of the tax system, Congress enacted special rules that apply to the depreciation of listed property. So listed property includes assets that essentially can also be used for personal use, and that includes the following: passenger automobiles under 6,000 pounds or less unloaded gross vehicle weight. There's obviously certain exclusions. Other property used as a means for transportation, which includes trucks, buses, boats, airplanes, etc. Property that's generally used for entertainment, recreation, or amusement. And if the listed property is used 50% or less for a qualified business purpose, they have to use the straight line method to calculate depreciation. And the election to expense under Section 179 in bonus depreciation, unfortunately, it is not allowed. In addition to the limitation on the depreciation of passenger automobiles that's imposed by the listed property rules that we just discussed, the depreciation on passenger automobiles is subjected to an additional limitation. And this is commonly referred to as the luxury automobile limitation. So essentially, regardless of the method of depreciation that's used by the taxpayer, whether it's accelerated or straight line, the election to expense, bonus depreciation, the amount of depreciation expense that can be claimed on a passenger automobile is subjected to an annual dollar limitation. And the annual dollar limitation that apply to these passenger automobiles acquired in 2023, they are listed below. So in year one, 20,200, and this includes bonus depreciation. Year two, 19,500. Year three, 11,700. Year four, in subsequent years until it's fully depreciated, $6,960. Vehicles that have a gross rating above 6,000 pounds, they're not considered passenger automobiles, and they can be depreciated or expensed under Section 179 or bonus depreciation without regard to the passenger automobile depreciation limits. However, they are limited to 28,900 as it relates to Section 179 expenses, and they may depreciate using a 5-year MACRS percentage. Annual limitations must be reduced to reflect the actual business use percentage if the business use is less than 100%. So here we have this example. It asks to calculate depreciation on the automobile. On March 15, 2023, James purchased a new automobile for $52,300 to utilize in his sole proprietorship that sells medical devices. The automobile weighs less than 6,000 pounds and is used 60% for business. James elects out of bonus depreciation. So in this example, we see that the total cost is $52,300. We multiply it by 60% because it states here that it's used 60% for business. So the basis is $31,380. That is the depreciable basis. The MACRS depreciation using a half-year convention would be subjected to 28%, and the maximum luxury automobile depreciation allowed would be limited to 60%. So because of the luxury automobile limitation is more than the actual depreciation calculation, then in such case, the depreciation would be $6,276. Next, we move on to intangibles. If you remember, as mentioned previously, intangible, that is essentially, items that have value. However, they cannot be perceived with the five senses. You can't see it, you can't touch it. So there's two main categories of intangibles. We have Section 197 intangibles, and we have non-Section 197 intangibles. So Section 197 intangibles, these are those that are acquired by the taxpayer as part of acquisition of a trade or business. This includes, but not limited to, goodwill, going concern value, know-how, covenant not to compete, a franchise, trademark, or trade name. And these are amortized over a 15-year period beginning with the month of acquisition, regardless of the asset's actual useful life. Amortization, it's similar to depreciation, and what it is, again, it's just for intangible assets, but it's the same concept. The cost recovery is spread over a fixed period of years. The key difference, however, is that amortization is different from depreciation in that it's applied to intangible assets rather than tangible assets. And in addition, one key thing to keep in mind is that it doesn't include the half-year or mid-quarter conventions. As it relates to non-Section 197 intangibles, they're separately acquired by the taxpayer. They're amortized over their remaining useful life using the straight line method, and this includes but not limited to interests in a corporation, partnership, trust, or estate, and interests in land. Section 197 exclusions that are generally amortizable include computer software, readily available for purchase by the general public, interests in films, sound recordings, video recordings, and similar property, and self-created intangible assets. So here we have an example. It states how much goodwill may Fiona Ware amortize in 2023 and 2024. In May 2023, Fiona Ware Incorporated purchased the small artisan textile company for $980,000. Part of the purchase price, $54,000, was allocated to goodwill in the buy-sell agreement. So based on this information, for 2023, we would multiply the amount, the 300, and how do we calculate 300? So the 54,000 divided by 15 years means that each year there's depreciation of $3,600. But we want to find it on a monthly amount. So 3,600 divided by 12 months means that it would be depreciated by $300 per month. What we see, however, in 2023 is that she purchased the company in May. So therefore, she can only claim depreciation for the months for which she had the property. So therefore, 300 per month times 8 months. In 2023, the amortization would be 2,400, and in 2024, 3,600. Next, we move on to section 1231. So with section 1231, this is essentially dealing with assets that are not capital assets, but they are given special treatment. So section 1231 assets include depreciable or real property used in a trade or business, timber, coal, or domestic iron or livestock, not including poultry, held for draft, breeding, dairy, or sporting purposes, unharvested crop on land used in a trade or business. The following are not considered section 1231 property: any property that's held 1 year or less, inventory and property held for sale to customers, copyrights, paintings, government publications, etc. Section 1231 assets, they are given special tax treatment. So gains on section 1231 assets, they may be treated as long-term capital gains, while losses in some cases, they may be treated as an ordinary loss. Why is this important? Because if it's treated as an ordinary gain, ordinary gains are subjected to ordinary tax rates, which are generally higher, versus long-term capital gains, which are taxed at 0, 15, or 20%, depending on the taxpayer's income. And it is also beneficial as it relates to losses if it is treated as an ordinary loss versus a capital loss. Capital losses are subjected to a limit of $3,000 per year, whereas ordinary losses, you can claim the full amount of the loss in the year of loss. So if net section 1231 gains exceed the net section 1231 losses, then the excess is a long-term capital gain. If the net section 1231 losses exceed the net section 1231 gains, all gains are treated as ordinary income, and all losses are fully deductible as ordinary losses. Next, we move on to depreciation recapture. So since long-term capital gains traditionally, they've been taxed at lower rates as in comparison to ordinary income, as just discussed, taxpayers, they've attempted to maximize the amount of income that's treated as capital gain since it's treated more favorably. But as we know, Uncle Sam don't play that. So Congress, they enacted depreciation recapture provisions essentially to prevent taxpayers from converting ordinary income into capital gains by claiming the maximum depreciation deductions over the life of the asset and then selling the asset and receiving capital gain treatment on the resulting gain at the time of the sale. So there's 3 major depreciation recapture provisions. The first is section 1245. This generally applies to personal property. Section 1250, which generally applies to real estate, and unrecaptured depreciation that has previously been taken on real estate. So the depreciation recapture provisions, it can be, a bit complex essentially in nature, but we'll go over, some of the basics so you can get an understanding. So as it relates to the section 1245, so under the provisions of section 1245, any gain recognized on the disposition of a section 1245 asset will be classified as ordinary income up to an amount equal to the depreciation that has been claimed. And any gain in excess of the depreciation taken is classified as a section 1231 gain. Section 1245 property is depreciable, tangible personal property, so furniture, machines, computers, and automobiles. Any amortizable, intangible personal property, so for example, patents, copyrights, leaseholds, and professional sports contracts. Other intangible property except buildings used as an integral part of manufacturing, production, or extraction. Any single purpose agricultural or horticultural structures. So this is, what was mentioned earlier. Any gain recognized in the disposition of a 1245 asset claimed as ordinary income to the extent of depreciation, and the amount of ordinary income recognized upon the sale of a section 1245 asset is equal to the lesser of total depreciation claimed on the asset or the total amount realized on the gain of sale. Any gain recognized in excess of the amount of ordinary income treated as a section 1231 gain. So here we have an example. It asks, what is her section 1245 recapture? On April 1st, 2023, Francesca sells depreciable personal property used in her business. She purchased the property 4 years ago for $60,000. Francesca had claimed depreciation on the property of $25,000 and sold the property for $50,000. What is her 1245 recapture? So in this case, we see the amount realized was $50,000, how much she sold it for. And from there, we determine the adjusted basis. The adjusted basis is $35,000. It is the purchase price, which is $60,000, less the depreciation claim, which leaves a basis of $35,000. From there, we factor in the realized gain, but we need to account for the total depreciation that was taken. So here we see the amount of section 1245 recapture, which is the gain that is going to be characterized as ordinary, is $15,000. And it is essentially going to be the lesser of the realized gain of $15,000 or the total depreciation that was taken of $25,000. So therefore, this $15,000 is going to be treated as recapture. Next, we move on to section 1250. With section 1250, this applies to the gain on the sale of depreciable real property, other than real property included in the definition of section 1245. So section 1250, real property recapture, is the excess of depreciation expense claimed using an accelerated method of depreciation over what would have been allowed if the straight line method has been used. However, because the straight line method must be used for real property acquired after 1986, section 1250 rarely occurs. Next, we move on to unrecaptured depreciation on real estate, which is the 25% rate. So for non-corporate taxpayers, there's a special 25% tax rate that applies to real property gains attributable to depreciation previously taken and not already recaptured under the section 1245 or section 1250 rules as just discussed. So any remaining gain that's attributable to unrecaptured depreciation previously taken, including straight line depreciation, it is taxed at 25% rather than the long-term capital gain rate of 15%, right? So that's definitely something to think about, because obviously if you have clients that have, real estate, this is something for them to determine before they essentially, sell the property. They're going to want to talk with you first because obviously they're going to want to make sure that they have enough money saved because, Uncle Sam don't play that. And those interest and penalties, if you file a return without it, being paid by April 15th, can be fairly hefty. So here we have this example. How is it split between a Section 1231 gain and unrecaptured depreciation? Ella, an individual taxpayer, acquires an apartment complex on January 1st, 1989 for $7 million, and she sells it on September 3rd, 2023 for $8,500,000. The accumulated straight-line depreciation on the property at the time of sale is $6,100,000. Ella is in the 32% tax bracket for ordinary income. She is not subject to the 3.8 net investment income tax. What is Ella's realized gain on the sale of the property? How is it split between Section 1231 gain and an unrecaptured depreciation? So in this example, we see the realized gain is as follows. It's the $8,500,000 minus the $900,000. And how do we calculate the $900,000? So since $6,100 is the gain attributable to the unrecaptured depreciation, it's taxed at 25%. So the $900,000 is calculated as follows. The $7 million, which is how much she paid for it, minus the depreciation gives her a $900,000 adjusted basis. So that is how we determine the realized gain of $7,600,000. So of that, as mentioned before, $6,100,000 of the gain is attributable to unrecaptured depreciation, and that amount is going to be taxed at 25%. Whereas the remaining $1,500 gain is going to be taxed at the 15% long-term capital gains rate. Next, we move on to business casualty gains and losses. The treatment of casualty gains and losses differs depending on whether the property involved is held for personal use or held for business or investment purposes. Therefore, a taxpayer's business and investment casualty gains and losses is computed separately from personal casualty gains and losses. The deductions for personal casualty losses, they're restricted to those that are associated with a federally declared disaster area. So something to keep in mind. And then even for personal casualty gains and losses, those are subjected to itemized deductions. So obviously, there's some different rules. So as it relates to the business casualty gains and losses, if it's completely destroyed, the loss is the adjusted basis of the property less any insurance reimbursement. If it's partially destroyed, the loss is insurance proceeds less the lesser of the adjusted basis at the time of the casualty or the decrease in the property's fair market value associated with the casualty. And the treatment of gains and losses depends on the holding period. If the property was held for 1 year or less, gains from trade or business property and investment property, they're netted against losses from the trade or business property. And net gains or losses are treated as ordinary income or ordinary losses. Property held for over 1 year, gains and losses from trade or business property and investment property, they're netted, and the net gain is included in calculation of Section 1231 gain or loss, and net losses, they're excluded from calculation of net Section 1231 gain or loss, and the tax treatment depends on whether the property was trade or business property or investment property. Next, we move on to installment sales. And with an installment sale, this is essentially where some taxpayers, they sell property and they don't receive payment immediately. Instead, they take a note from the purchaser and they receive payments over an extended period of time. So it might be a financial hardship to require those taxpayers to pay tax on all the gain on the sale of the property when they didn't even receive the cash, right? So in order to provide equity in those situations, Congress passed the installment sale provision. And with the installment sale provision, this allows taxpayers to spread the gain, but not a loss, over the tax years in which the payments are being received. So on the installment sale, the taxable gain reported each year is determined by using the following formula. The taxable gain equals the total gain realized by the sale divided by the contract price, multiplied by cash collections during the year. In the contract price, this is the amount that the seller will ultimately collect from the purchaser, and this is usually equal to the property's sales price, less any mortgage or notes that have been assumed by the buyer. Taxpayers who receive payments over a period of time, they'll automatically report gain on the installment method unless they elect to report all the gain in the year of sale. Regardless of whether the installment sale method is used, any recapture under Section 1245 or Section 1250 must be reported in full in the year of sale. And any remaining gain, it could then be reported on the installment method. And Form 6252 is used to report these installment sale gains. Next, we move on to like-kind exchanges. Although taxpayers, they'll realize a gain or loss on the sale or exchange of property, the recognition of the gain or loss, it may be deferred for tax purposes. So again, defer doesn't mean that they'll never recognize taxes. It just means that there's a delay. It's postponed. So one example is when a taxpayer exchanges real property for other real property of a like kind. So under these circumstances, the transaction, it may be non-taxable. So in order to qualify, the property exchange, it must be real property, must be held for productive use in a trade or business, or held for investment. Unfortunately, any exchanges of personal or intangible property used in a business or for investments such as car, truck, patents, furniture, etc., those don't qualify as like-kind. In addition, property held for personal purposes such as a taxpayer's residence, those also don't qualify for a like-kind exchange. And taxpayers, they must file Form 8824 to report the exchange of property even if no gain is recognized. For exchanges that include cash or other property in addition to the like-kind property, gain is recognized in the amount equal to the lesser of the gain realized or the boot received. Boot is essentially money or fair market value of other property received in addition to the like-kind property. And if there's relief from a liability, that is also treated as a boot. The basis of like-kind property is calculated as follows. It's the basis of the like-kind property given up plus any boot received, or any boot paid rather, minus any boot received, plus any gain received. That determines the basis of the property received. So we have this example here. It's asking, what is Brent's realized gain, recognized gain, and new basis in the land? States Brent exchanges his marina in Alabama for Amari's Missouri land. The marina has an adjusted basis of $175,000 and a fair market value of $305,000. The land has a fair market value of $305,000. Brent also gives Amari cash of $25,000. So in such case, to determine the realized gain, it would be the fair market value of the property received, less the boot paid, less the adjusted basis of the property given up. That would determine the gain realized of $105,000. And since Brent received no boot, the recognized gain is zero. In order to determine the basis of Brent's new land, it's the basis of the property given up, which was $175,000. We add the boot paid, we subtract zero, no boot was received, and we add zero because no gain was recognized. So therefore, Brent's basis in the new land would be $200,000. All right. So this brings us to our last concept of this chapter, which is an involuntary conversion. So as it relates to involuntary conversions, what this simply means is that if there's a destruction of the taxpayer's property in whole, in part, or loss of the property by theft, seizure, requisition, or condemnation, in such case, the taxpayer, they may elect to defer the gain on an involuntary conversion of property, provided certain conditions are met. So in order to qualify, the taxpayer must obtain qualified replacement property similar or related in service use within 2 years after the close of the tax year in which the conversion occurred. A realized gain on involuntary conversion of property occurs when the taxpayer receives insurance proceeds or other payments in excess of adjusted basis in converted property. If the proceeds are reinvested within the 2-year time period, no gain needs to be recognized. If the proceeds are not reinvested within the 2-year time period, a gain must be recognized equal to the amount of proceeds not reinvested. The basis of the replacement property will be equal to the cost of the replacement property less any gain not recognized on the transaction. And keep in mind, this involuntary conversion provision, it applies only to gains and not to losses. So that brings us to the end of chapter 8, depreciation and sale of business property. So we covered a lot. And now that the lesson has ended, you should have learned how to explain the concept of capitalization and depreciation, calculate depreciation expense using the MACRS tables, identify when a Section 179 election to expense the cost of property may be used, apply the limitations placed on depreciation of listed property, apply the limitations on depreciation of luxury automobiles, calculate the amortization of goodwill and certain other intangibles, classify gains and losses from Section 1231 assets, apply the depreciation recapture rules, apply the general treatment of casualty gains and losses for business purposes, compute the gain on installment sales, calculate, recognize, and deferred gains on like-kind exchanges, and lastly, calculate, recognize, and deferred gains on involuntary conversions.